For the latest in strategic affairs, subscribe to our YouTube channel. Click the bell icon for more updates.
Did you know that India's stock market is among the top 5 in the world in terms of market capitalization? Did you know that if we take the trade in derivatives and equities together, NSE is the largest stock exchange in the world? If that didn't surprise you, try this. India's stock market investor base, measured by NSE, touched 8.5 crore this December, rising by a fifth. 30 years ago, this number was 30 lakhs. Hello and welcome to another edition of Capital Calculus. I'm your host, Anil Padmanabhan. Beginning last month, India's stock market indices have been on a tear. If the Nifty crossed the psychological barrier of 20,000 a few months ago, now it has the turn of the Sensex. Over the last few weeks, the Sensex has gone from strength to strength. It just topped 72,000. What do we make of this so-called bull run in the Indian stock markets? Is this all about animal spirits? Or does it have something else that it is signaling? Is it holding a mirror to the changing contours of the Indian economy? After all, stock markets are also a bet on the future. To look under the hood, as it were, we spoke to Somnath Mukherjee. He's a managing partner at ASK Wealth Advisors. I began by asking Somnath to explain the significance of the Sensex and Nifty achieving new milestones.
From a level perspective, whether it is 20,000 or 70,000, the number itself doesn't mean too much because it's just an index and it's an indexed number. And as we go forward in time, hopefully it sort of keeps increasing. The way I look at it is all of us alive today, you, me, everyone else, is at our all-time high age as of today. So why shouldn't everything else progress at the same time? Because if mankind is progressing on a minute-by-minute, day-to-day basis, most things should also go up. So the fact that markets are at an all-time high or at a specific index level, which is a nice sort of milestone, is not terribly relevant. I don't think that itself is that much of an insight. But what is true is that the Fed stance that came about yesterday, last night, in fact, is something that will give further sort of bit of tailwind to risk assets across the world. And we have seen that play out in the US, we've seen that play out in India. Across most risk assets, it's getting played out. So it'll probably continue for a while, for a bit.
So Somnath, the growth that we've seen, you have a great point about that milestones just need to be observed, not celebrated. But the issue is that if you look at the growth, the path to both 20,000 or 70,000 has been like a hockey stick growth, right? So how do you see that, that the trajectory is steepening, as it were?
I don't think that the trajectory is steepening, because when you say it's hockey stick, it means that the growth in market prices at an index level is accelerating. Actually, there is no discernible acceleration if you take a slightly longer term perspective. What happens is everyone looks at the same blue TV screens that are typically open on mute in most banks and financial services organizations, and start reacting to tickers as they move on a daily basis. But if you look at a slightly longer term horizon, say over a 20-30 year period, Have we seen Nifty returns accelerate over, say, 5 years or 10 years? Actually, no. You look at the last 5 years or the last 10 years, the numbers are probably a little lower than the previous 10 years. Not probably, they are somewhat lower than the previous 10 years. So it's not as if the markets are doing something that is completely out of whack, or this is absolute new territory as far as market returns are concerned. So no, I don't think that there is any discernible hockey stick that we can see as far as market performance is concerned.
Okay. So then how would you characterize this rally?
So a mix of various things. One, of course, is that this year, contrary to what a lot of people were expecting, we have had a pretty strong pretty strong set of global macros, and that spans most of the major economies in the world. The big surprise, of course, has been the US, where we not only didn't see either a hard landing or a soft landing, we actually have sailed through the year with no landing at all. US data still remains strong, and in some ways, they seem to have pulled off a bit of a miracle. Not only have they dampened down inflation, which was looking sticky in the beginning of the year, they have also managed to do so without sacrificing too much in terms of job market tightness. The US job market at an aggregate level remains as tight as it can be. So global economy has been relatively sanguine and fairly large, and that includes China as well. I mean, one can obviously question Chinese data, but all said and done, China has, for the size of its economy, also sort of gone through the year without a major hiccup or blow up, despite repeated risks and a lot of concerns expressed around its real estate sector. China has also sailed through pretty well. So has India. So in general, economies have done well. Second, at the same time, specifically for India, we've also seen another point, which is this year has continued a 2 to 3 year trend of reversion back to mean of corporate profits as a percentage of GDP. Now, it had been on a near secular downtrend for a very long time, probably a decade before that, till about 2020, 2021. Corporate profits as a percentage of GDP had gone down to levels of 2.5%, 3%. Now that has started coming back on. Some of that is a result of banks springing back to profitability, and some of them springing back to very large profitability as well. But it's also a little more widespread than the banks. We have seen a situation where many more companies are also participating in that profit pool. So not only has share of profits in aggregate GDP gone up, but the profit pool has also gotten a lot more broad-based. Till about in 2020, 2021, approximately 25 companies in the listed side accounted for something like 75% of the profit pool of the listed corporate India. Now that number is a lot better today. So the number of companies that contribute to 75% of corporate profits is a much bigger number. It's closer to 70, 80. So two things have in parallel happened. One, profitabilities have generally gone up, and second, the profit pools have gotten or mean reverted to being a lot more widespread and egalitarian. And that has resulted in a significant amount of opportunities in the market that has entrusted or enthused investors to come in. And the third reason, and I think that's a that's a very key and probably the most structural of all reasons for the market bullishness, is over the last, and this is a slightly longer term trend, but it has sort of come into a hockey stick phase, as you use that word, in the last 3 years, is domestic flows into equity markets, led by SIPs, but by no means only restricted to SIPs. domestic flows into equity markets have been so strong that they have started obviating to a large extent or mitigating to a large extent the impact of FIIs. And a very good example of that was the year 2022, when FIIs pulled out something around $15-16 billion of money from the markets. But guess what? The Indian markets were up 4.3% that year. In a year where S&P was down 20%, globally most markets were down primarily on account of fears of recession and massive tightening by the Fed and so on and so forth.
Somnath just flagged a very important point. He said, part of the buoyancy in India's stock markets in recent years is because of the rise of the domestic investor. They have provided a floor which has ensured depth and less volatility in the stock market.
The Indian markets held up and held up pretty well, primarily because there is a very strong pool of structural domestic liquidity that has 3 or 4 different angles. One is, of course, retail mutual fund flows and SIPs. SIPs are leading that. Second is the participation of employees' provident fund. So 10% of incremental flows has to get into equities. There is no other choice. Third, a smaller chunk comes from the national pension scheme, which is again something that is a chunk that has to be deployed in equities, and there is no option but to get into equities. So between SIPs, NPS and EPF, we have roughly between 70,000 and 1 lakh crores of flows that could be termed as SLR for Indian equities. Just as banks need to maintain a 19% SLR on their balance sheet, so they have no choice but to deploy 19% of their deposits in government securities, which forms a floor to bond prices, government security prices. Similarly, there is between 70,000 and 1 lakh crores of flows that are destined for one investment only, which is Indian equities. And therefore, that provides a fairly strong floor, or that reduces the volatility for other flows that can be in or out depending on investor sentiment. And that has meant a couple of other things as well. FIIs pulled out massive amounts of money last year. Typically, since the time FIIs have been investing into India, which is 1993 onwards, we have seen that while it is true that FIIs have not been fair weather friends, more often than not, overwhelmingly, they have been positive flows into India from FIIs than there have been negative flows, which is outflows. But yet we have seen that FII flows directions have traditionally had an outsized impact on level of markets. But in 2022, we saw the opposite. FIIs had one of the largest outflows ever from Indian markets, and markets not only held up, but it was sort of mildly positive. Now, imagine an equity manager sitting out of New York, London, Singapore, Hong Kong. He's allocating money to various markets, and he pulled out $15 billion from India. He would have deployed that money somewhere, right? He would have deployed that money in China. He would have deployed that money in the US. Typically, an allocation to India will not go to the US, but for argument's sake, let's say he deployed in the US, China, wherever, Europe. Now, whichever market he deployed it in 2022 would have performed worse than India. So, suddenly you had a situation where a very active call made by the manager, and I'm simplifying the matter. Obviously, there are multiple reasons why FIIs pull out money, and not all of it is manager discretion around geographies. But if that were to be the case, there is suddenly a situation where you've created a massive negative alpha for yourself. Not only have you missed out by pulling out exposure to one of the best performing markets, you have ended up deploying in markets that are actually going down significantly in that year. And you saw that domestic investors in India held the market up. So there's a little bit of a FOMO affair about India as well that came on. But I think the key point, the key takeaway is that the enormous confidence of domestic investors in the equity markets, and it's just not a matter of confidence, it's also a matter of regulations. Frankly, most Indians cannot access global markets all that easily. But between the two, the structural liquidity that is getting into equity markets has caused a significant amount of dampening of volatility and a ballast to equity prices. I think all of it put together would be the defining factors for why markets have been so buoyant. And going forward, the last point, so everything else can change. Outlook on interest rates can change. Outlook on risk appetite can change. US can move into recession. Who knows? But what is more structural is the amount of non-discretionary liquidity, domestic liquidity that is getting pumped into equity markets in India.
The rise of the domestic investor has altered the demographic profile of India's stock markets. Within that is a key cohort, the retail investor. In turn, this tells the story of the growing democratization of the business of stock markets in India.
Absolutely. I think the mutual fund industry generally in the popular media tends to get a lot of flack. But I think something that they've done right over the last several years now is they have used their distribution, they've used their knowledge to propagate the idea of risk investing to every nook and corner of the country. And we can see by the sheer growth in both demat accounts and mutual fund folios. Again, something that has a hockey stick. If you look at the last 3-4 years, those are the spaces that we've added some, we have doubled the number of demat accounts in the last 2 years that we had in the previous, whatever number of years that capital markets have been in existence. Ditto with mutual fund folios, despite the fact that there's been also operationally a lot of work over the last few years to amalgamate and consolidate multiple folios to one. The growth in folios has remained quite buoyant as well. So the education part of risk investing cannot be underestimated, and I think the mutual fund industry has done a great job of doing that. Having said that, our participation or penetration of risk products, especially equities, in households still remains tiny. Now, that's partly to do with also the fact that most things about India, penetration is tiny. I mean, outside of mobile phones and basic clothing, I think penetration of everything in India is tiny, whether it is automobiles, two-wheelers, electronics, everything in India boils down to a tinier and tinier sliver of the population. Having said that, the tiny penetration of risk products in the population also gives rise to expectations that it can grow a lot more, which is true for everything else as well, but true for risk investing as well. So the amount of education done has been very good. And the second thing is, what's and all, the regulator has also consistently weighed in very heavily in favor of the investor. And in this case, the primary regulator being SEBI, they have weighed in consistently and extremely heavily in favor of the small investor. Fees have consistently come down. Expenses have been brutally hacked. And so it has become easier and better to access the markets. At the same time, what has also continued is the fact that Indian financial services architecture, which was always a world-leading architecture. A lot of people again forget that India got its first fully online stock exchange when NSE came on board in 1995. For many years since then, New York Stock Exchange was not fully online. I think New York Stock Exchange got fully online only a few years back. Similarly, what people are now over the last few years using blockchain and everything to try out third-party interbank funds transfer. In India, banks started doing third-party interbank funds transfer in the early part of the 21st century when NEFT and RTGS came into existence. So the overall sophistication of India's financial services infrastructure and the extensive education that the industry has done, as well as very, very investor and small investor friendly regulatory regime, all of it put together has meant that it is heavily democratized in terms of participation. I think the only thing now is affordability. People who have the surplus to invest are increasingly making that call.
To sum up then, the recent surge in stock market indices have been inspired by the structural factors as well as the usual dose of animal spirits. The standout feature though, in my view, has been the big bet by the domestic investor, and within that, the cohort of the retail investor. Thanks to mutual funds launching SIPs, this investor base is beginning to acquire a national footprint. It shouldn't surprise you then to know that Uttar Pradesh is the second largest investor base in the country. Now, all of this is not happening in a vacuum. The Indian economy has not only withstood the big shocks that came after COVID-19, but has since recovered and is now looking at a trend rate of growth of 7%. Clearly, India is at a point of inflection. If all goes to script or to plan, then India's best is yet to come. Presumably, that also holds true for India's stock markets. Thank you for watching. Don't forget to subscribe to StratNewsGlobal on YouTube. Hit the bell icon so that you don't miss any updates. And please to share your thoughts, ideas and suggestions with us. I'm available on Twitter at Capital Calculus. I'll be back next week with another episode. Till then, stay safe.